Well, President Biden has signed the Chips and Sciences Act, a $280 billion law, which aims to turbocharge semiconductor production in the U.S. For more on the legislation and what it means for the wider industry, let's bring in Stacy Rasgon. He's Bernstein Research Managing Director and Senior Analyst of U.S. Semiconductors. Stacy, we'll get into the moves of the semis today. Certainly not a good day in the markets, but Let's start with what we have heard from President Biden. He's obviously touting this as a big bet on U.S. manufacturing at a time when we have seen the dramatic shift over to Asia in terms of market share. How much of that share comes back as a result of this?
So you'll see some, and this is the whole point of the CHIPS Act. It's not really going to determine over time how much additional capacity gets built worldwide. That's going to be determined by demand, not by politicians. The goal is to determine where some of that incremental capacity gets built. We obviously want to get it started here in the U.S. because we are getting increasingly dependent on places like Taiwan. And so the CHIPS Act will actually help some of these projects get started here in the U.S. versus getting built elsewhere. Now, is it going to structurally improve the percentage of total worldwide semiconductor capacity that is here in the U.S. versus elsewhere? Probably not. I think the U.S. right now has something like 12% of total installed capacity. I would be surprised if this act, which is about a little over $50 billion over 5 years, structurally improves that percentage, just given the magnitude of the types of investments that one typically sees in this space. But it is a start, right? You have to start somewhere, and it will at least get the ball rolling on some of this.
Stacy, as we continue to watch what's happening in the U.S., this comes at a time when there's also discussions about building some kind of CHIPS alliance among value or like-minded countries, if that's the way you want to put it. You're talking about countries like U.S., Japan, South Korea. I mean, you're already seeing some decisions being made because of this CHIPS Act from foreign players. How much of that also kind of spurs that movement towards the U.S. or away from China?
So we're trying to create, something like some sort of a push against the growth of China. I mean, we've been doing this for a while. I mean, even under the Trump administration, there were a lot of sanctions that were put in place, both on semis as well as the broader supply chain. They sort of chopped Huawei's knees out from under them. So they've been doing everything that they can to try to, at least on a relative basis, strengthen sort of the Western push on semiconductors versus what's going on in China. So this is a continuation of that. The problem is, and it's very, very difficult to completely disaggregate. These supply chains are very tightly interlinked, not just in semiconductors, but everything upstream and downstream that happens. It's very difficult to completely carve off sort of like the Western side from China. They don't really exist very well apart. It's going to be very interesting to see how this whole thing evolves over the next, 5, 10, 20 years. But obviously, they are trying to, at least to the extent that they can, reduce their dependence on what's going on in China right now. And some of these new initiatives and new partnerships are a step along those directions.
Stacy, Brian, Cheung here. As you mentioned, that's kind of a longer term picture. Let's talk about the short term, specifically also with NVIDIA, because they had an interesting kind of preemptive move this week by saying that they expect their second quarter revenue to maybe take a step down compared to their outlook, mostly driven by weaker gaming revenue. Your note suggests this was going to have to happen. Can you elaborate?
Yeah, so you can see the chart right there. I guess that's the gaming revenues, right? So they've been like on fire for almost 2 years. They've had a very strong gaming cycle, and there's been a lot of question on how sustainable this is, especially as supply and demand have normalized. And usually when that happens, what you typically find just generally is that the strength of orders, it's not actually as strong as you thought it was. Customers tend to order more than they need when they can't get what they want. And as supply and demand kind of normalizes, some of those orders go away. The other thing that we've had, obviously, is crypto has imploded. And there's always the question of how much of the GPU revenues are actually not being targeted primarily to gaming, but rather to cryptocurrency mining. If you're monitoring the signs in the GPU space, and all the investors have been, they don't look good. We've seen aftermarket pricing starting to come down. We've seen the supply and demand trends start to normalize. We've had shortages that have very quickly gone and turned into gluts. And so I think investors have been broadly expecting a reset. The question was it going to be this quarter? Was it going to be next quarter? Were they going to wait until the earnings announcements in a few weeks to tell us, or were they going to pre-announce it? And so they kind of cleared the deck. They got it out of the way early. I think it was actually kind of healthy. And if you look at the stock movement yesterday, it was only down about 6% for a relatively sizable earnings cut. in that context, I think it kind of tells you where investor mindset was. Many investors were already expecting something like this.
Yeah, Stacy, another company that, we've been watching closely, Intel, and I can't help but think, I was looking at your notes from, I think it was June, where you said we see no reason to own Intel, and specifically said they had a questionable growth model. This is before the most recent pullback that we saw on the back of their quarterly results. I mean, this is a company that's saying we're building the future of U.S. manufacturing in chips. What's your biggest concern?
Well, this is part of the problem. So they're going to get a bunch of money from the CHIPS Act. Yes. Now, it doesn't just go on their balance sheet. They actually have to put it in the ground. They actually have to build factories in order to get this money, and they're going to be deploying a lot of their own capital at the same time. But that's the question: is what happens once these things are built? Are they going to be able to fill them? They're trying to actually build a third-party manufacturing business to make parts for other players to try to reduce that dependence on areas like Taiwan. It's very questionable whether or not they're actually going to be able to attract enough customers in order to do that. And I'll be honest, frankly, if we were really, if the goal was really to structurally improve the amount of actual like third-party demand that's getting manufactured in the U.S., I don't know if Intel is the right horse to bet on. I mean, the right thing to do might have been to give TSMC a bunch of money to build a ton of fabs here, because they already know what they're doing in terms of third-party foundry manufacturing, and they already have customers, right? So the question of whether or not in like 5 years Intel can actually build a real viable business out of this, I think is hugely open for debate right now. But taxpayers are going to be, we're going to have a front row seat to whether or not that they can actually do something with this.
All right, we're going to have to follow up in, I guess, about 5 years. Stacy Rasgon, Bernstein Research Managing Director and Senior Analyst of U.S. Semiconductors. Thank you so much